All right. So here we are with Sean Stevens. We're in the contest here. He's looking at ways to identify opportunities. He's kind of put together some things he thinks he's bullish on and bearish on. And so how would you like to use our time here today?
I'd like to walk through actually doing some of these. So
okay.
if it's me clicking, or it could be you, directing me as I'm sharing my screen with you or something like that. So I have a strangle that I want to do. A poor man's covered put.
Okay.
I'm kind of bullish more on an airline from standpoint of Southwest Airlines. So I might want to do something there. Maybe a poor man's covered call. And then when I was talking about D-Dog, it's Datadog, and they are a cloud computing software that's actually kind of taking off right now.
Okay.
So I want to look at maybe doing something like that. And again, my whole objective is just to put these trades in there and then be able to watch them and see what happens.
Sure.
So
now, is it easier for you to, now tell me, do you have multiple screens? Do you have one screen? You have to shrink and you got one screen. So is it easier for you to watch me do it and then stop the screen share and let you do it?
Either show me how and I'll go out and replicate that maybe later tonight.
Well, what about if I show you on one of the trades?
Okay.
And then you can go in and put them on for the rest of them.
Okay.
Does that sound reasonable?
Sounds good. The strangle is probably going to be the one that's going to be a little more interesting and difficult.
Okay. And so there may be some aspects of kind of understanding kind of what a strangle is. So let me just go ahead and share my screen with you, screen number 3. And this is my account. I've named it Nobody Knows Anything, which is kind of a philosophy of mine. So everybody claims to be an expert, but I think truthfully, nobody knows anything. So I'm going to click on this up here, which says execute. And Mo's with us here, Mo, and I'm just showing Sean how to put on. And Mo's in the contest.
Yeah, I've seen his name.
Yeah, Mo's gambling it up. So we're kind of trying to compete with the gambler, and he's the archetype for the gambler. So Mo, I'm just showing Sean how to put on a few things here in the trade. So he's just getting started. So execute a simulated trade. So give me one of them that we were looking at putting on.
Okay, hold on. Let me go back to my notes here.
What's the underline?
Remember Ford? I was bearish on Ford.
Okay, Ford. Now there's 2 ways you could put on kind of a bearish trade on Ford. We could do a poor man's covered put on Ford, which is a good way of putting on. It gives you positive theta decay while at the same time allowing you a bearish. So I had suggested like maybe buying the August 7 puts and selling the 550s. Now
so
you
it's
may not.
It's hovering right around 5, and I think that the automotive industry is probably going to take a bigger hit.
So if we buy, the way a poor man's covered put works is you buy something that's in the money. The further you go in the money, the less risk you take. So if we bought this one at 7, okay, and then we sell the June out of the money, so let's say at 5.5, okay. So, and then over here, the yellow cranks up the number of contracts.
Yep.
It does it for both legs. If you go down here, it just is it'll crank it up for the one leg. Okay, so you want to crank it up for the both legs. So if you put it on for 10 contracts, that uses only 1150 in margin because it's such a small underline. Okay. Then when you're done, you click on submit, and then you come up here and click on your portfolio just to make sure it exercised.
Okay, so why did I Why did I take two different numbers? Am I giving it a range? I thought that was a strangle.
No, you're buying the $7 put and you're selling the $5.50 put. That's the definition of a poor man's covered put. Essentially, what you're buying serves as a synthetic. So, you know, when you do a poor man's covered call, you're not owning the call, but you're actually owning the option. Mo, I'm getting some background connection. Could I try to mute you and see if it's coming from you? Yep, it was. All right, so Mo's muted. So can you hear me, Sean?
I can.
All right,
I'm just going to take a few notes so I can replicate this.
Yeah. So if you want, let me switch back and I'll bring you to toss and I'll show you what the risk graph looks like that. So you can kind of begin to better understand it. Meanwhile, what you might do is watch some videos on poor man's covered puts to be able to really understand it.
Okay.
So let me slide this over, put my privacy on since we are recording it so you don't see kind of my account numbers. I don't want to share those with the world. But, you know, if we do this for Ford and I buy the July 7th puts and I'm selling the June 5.5s. Okay, now what I'm going to do is crank this. I'm going to do an analyze tab just to kind of show you what this risk graph looks like. So what happens is Ford is currently trading at $5.92.
Okay.
Okay, so here's what it is today. The purple line is if we closed it at today's price, what we would make. The green line is what if we closed it at expiration at that price, what we would make. So see these squares down here?
Yeah.
As I move it and it starts to go south, the price, watch what happens at expiration. See how you begin to make $400 if it goes down to $5.45 by expiration?
Mm-hmm.
See, that's a bearish play. So you start losing money when Ford goes above 6, and anything below 6 you make money on at expiration.
Okay,
I don't expect you to have total understanding, but you get an idea that it's bearish, and you make money the more it goes down. So that's an example of Ford, and I'll now move back and now bring back the paper trader. So you kind of understand now how to set up the trade and then the fact that it's bearish. So do you think you can put on the other ones that I suggested using it?
I think so. Yeah, I can do the one D-Dog that we were talking about here. You wanted me to do a poor man's cover call on Southwest, and I think I've got that here. And the strangle. Yeah, the strangle. The J&J strangle.
The J&J strangle. Now let me explain how to set up groups for you, because what I see how in my account I've set up a group for poor man's covered calls, poor man's covered puts, strangles, and naked puts.
I can do that because you showed me once before.
Okay, and you know how to put them into groups?
Yes.
Have I showed you how to close a trade?
No, I don't think so.
Okay, so I'm in my account right now. Let's assume I wanted to close both legs on Facebook. I can right-click, hover over it, right-click, and just go down to close and then left-click.
You know that we're looking at you. We're not looking at your screen.
No, I didn't. I'd stopped sharing, didn't I? Thank you. All right. So see now, can you see my screen?
Hold on. Yes, now.
Okay, so see how it says Facebook here?
Mm-hmm.
I can right-click on it. See how it says close?
Mm-hmm.
If I left-click that, it would close it at the market price right now, or at the mid price. And I'm looking at my portfolio.
If you want to close the entire Facebook trade, you click on that top level
Yeah,
trades.
and that's Mike Carmendro that's speaking right now. If you just wanted to, if you wanted to click one leg, you hover over that leg, highlight it, and then right click.
Okay. That's when I want to end it, right?
That's when you want to close it.
That's when I want to close it.
Yeah. Up here, execute simulated trade is when you want to open it.
Okay.
Okay.
Thank you for showing me.
You're welcome. All right. So Sean, I know this was kind of I wanted to get your questions primarily. There's several things I want to get in today. One, I want to demonstrate a real trade of a strangle, which might also help you understand strangles. But there's also an earnings trade that I was going to put on today in my real accounts. And I thought you might benefit from learning about a strangle and setting up a real one on an earnings trade today in Salesforce.
Okay.
So I want to show you a real one that I put on, and let me go into that account, and I'll share that screen with you. And I put this one on today in CRM. So if I go into monitor, field orders, CRM, I sold the 172 put and the 200 call. It's in Salesforce. And it expires the end of day tomorrow. This may sound weird to you, and it is kind of weird, but what happens in earnings is you see all of that theta come out in one day. So let me show you kind of a risk graph of CRM. And once you learned how to use TOS, Thinkorswim, you can learn how to use this Analyze tab. And this shows me that there's a 98% chance of profitability. There's a 98% chance I could make $800 in this in one day. And so what a strangle is you're selling both a put and a call, and you're hoping that the price stays within this range. So I start losing money on this guy at 171.63, or if it goes above $200.70. And CRM is currently trading at $183.87. So let me put those on this.
What was the length of your strangle?
I like to do what's called 10 delta, and let me show you how to tell it's delta. Over here, and you may not have the same columns. If you don't, you can go in and set them up in here under configure these sections so you see delta. But as I scroll down this option chain, see this delta here number, and I'm looking for a 0.10, which we call that a 10 delta. Which means, yeah, so in this case, the 10 delta was 172.50. And then I look over here at a 10 delta, and the closest I could get here is a 12, 197.50. I think I sold the 200.
You did it 200, right?
Yeah, yeah. It's just a big, wide strangle. It's a high probability of trade. The market is expecting that the price after the market closes today in earnings will move up $8 or down $8. So from my calculation, if I add $8 to this price or subtract $8, the strikes I've chosen, it's well within the expected range.
Mm-hmm.
That's kind of the way I like to play earnings.
And that's just on a day where they're doing earnings calls.
That's a day when they're doing earnings. Now, it's risky because anything could happen during earnings. And a lot of times people avoid earnings because of that volatility. But I'm trying to take advantage of what's called the volatility crush, which once its earnings are released, all that risk comes out and then that theta decay dumps into your account. So that's kind of what I'm hoping to accomplish.
Interesting strategy.
Every now and then you get burned. So it's kind of like selling insurance during hurricane season. I mean, you get paid well for it, but you know, I guess if you're Warren Buffett, you can afford to pay out if you have to pay out claims.
Exactly.
So that's
a strangle, and that's a really
strangle.
short strangle. That's a short strangle,
Yeah.
right?
And the only time I do it one day to expiration is around earnings.
Okay. So, I obviously, having worked for J&J, I followed J&J stock for a long, long time. And J&J fluctuates a little bit. It doesn't fluctuate a lot.
Yeah.
And so that's a stock that I actually want to strangle.
Okay.
And I'm not going to do it on an earnings day like you're talking about, but I'm trying to probably put it out somewhere, give me enough time frame. And I know you did a video on a strangle. I think it was just yesterday or the day before that I can go back and I can watch, which will help.
Hey, Sean, just one comment. When you say you want to strangle a company like J&J because it's doesn't move a lot, like it doesn't have a lot of
it has some volatility, but it doesn't have a lot of volatility.
Right. So that just be aware that that's priced into the options. So that's why like I normally strangle tech stocks because they're pretty volatile.
Exactly.
So when you go to place a trade on J&J, you may find that the options, like, you can't go very far out, and you may find that it forces you to go very close. And
I did. I saw that in the option chain.
And you got to be careful because that's misleading sometimes. Because if you think J&J is gonna stay steady, that's usually priced in the options. And when you go try to sell a strangle, you may not be able to get very far out on the strangles, and it may be a less high chance, less chance of probability.
I haven't quite figured out the probability piece, that Dale was talking about. I'll have to add that to my analysis.
In general, you want to find a good balance between, like, a stock that has a pretty good range, actually. Like, and it might be actually counterintuitive because you actually want a stock that moves a lot.
Yeah.
In a way,
volatility.
Because it lets you go pretty, like, but then at the same time, it balances its stuff out. Tesla moves a lot. You can go out to Tesla and buy an option that's 50%, like a 10 delta. That's ridiculously out of the money, but that's also taking price in the option, and then also that's also potentially a more risky trade than the J&J trade. So.
When I first talked to my broker about doing options, he says, well, and of course I own a lot of J&J stock, right? So that it would not be naked. And so he was like, well, you probably don't want to do that with a stock like that. You want a stock that has a lot of volatility to it, because that's what they're paying the option for.
Yeah.
Right. Is to take out some of that uncertainty. So I get it.
One other option too is if you're okay with being naked, then you may be okay with selling calls on J&J. Like I have a position in PayPal where I own the stock, but I'm selling naked calls against it that are actually more than the amount of underlying that I control. So it's just for me a way to hedge and take advantage of theta decay. So.
Sean, let me show you a risk graph of a trade I set up on Johnson & Johnson expiring in July. And I sold the 130 put and the 160 call. This is the kind of trade that I like because it's got a 78% probability of profit. And you can collect, if you did 5 contracts, you collect $1.91. But it takes about $8,000 in buying power. You collect $950. Now, in a smaller account, however, you could scale this down to 1 contract, and you could collect $190, and it takes you $1,711 in buying power. Now, what Tasty Trade advocates, and I'm kind of a follower, is to take profits at 50% of max value. What they're trying to do is to kind of lower the variation that you'll have in your account. Now, the way I set this up is anytime you put a trade on, you can right click on it and you can go to Analyze Trade. Then you make sure that the one is checked that you want to analyze. Now, when you start, I'm going to reset this. These lines are going to be kind of all wonky like that. So what you can do is you can drag this graph so you can scale the numbers out. You can drag this over so it's easier to view. Then what I do is I drag one of these lines to that red hash mark, and that's where the point you start, that's your break-even point when you start losing money when it goes to the left of that. And move this one over to this hash mark on the expiration. So that's where you start losing money when it goes up too much. And then you make sure this is today's date, May 28th. This top line is June 20th. So I change my date up here to read June 20th. And then that then tells me up here my probability of profit. Now, granted, that may be a lot to take in a short amount of time, but the more you start using it, kind of familiarizing you, and you can play around with these strikes and change the probability of profits around, you know, until you get the one kind of that you're looking for.
Okay.
So, other questions?
None right now.
Okay.
Like, you know, I'm doing just a little bit at a time.
That's the way
getting
to
a
do
little
it.
more and more familiar with how this goes. I'm going to need to bounce so that I can go take this other call that I have coming up in a couple of minutes.
How do you eat an elephant?
One bite at a time.
Yeah, I'm not sure why anybody would want to, but you cut it up in little pieces and you eat it one bite at a time.
That's right. So I'm going to try a few things a little bit later.
Okay.
I can still do, I thought I saw Mike or somebody else, some trades out there that they did after hours that would go into effect the next day, right?
We do not want you to trade options after hours because we can't, because the pricing is inaccurate.
Okay. All right.
Well, what you saw is in place limit orders after hours, and then they fill the next day.
Okay. All right.
But in order to protect the sanctity of the contest, we want people to make trades during market hours.
Okay.
Well, you can't make trades. I took that off, so you can't actually make trades after hours right now. So don't worry about that.
Okay.
Don't worry about the mistake. But
you're
when
protecting.
You do that.
You're protecting me against myself.
We're trying to dummy proof it.
And we encourage you to kind of like if you're learning a strangle, you're learning a poor man cover call, just go put it on the paper, just go put it in the contest. So you know, not fully understanding it is fine, because you'll understand it more as you see it behave, you know, in real time on the contest. So
yeah, learn to swim, jump in.
That's why we have it.
And we'll jump in to save you. And I'm making some notes on other people's trades occasionally, so you can kind of look in comments. And I'll make some comments on everybody's portfolio along the way to kind of give you sprinkle in some tips and pointers.
Okay, so today and tomorrow I'll start adding a few things in there.
Perfect. All right, I'm going to go ahead and stop the recording. Yeah?
Okay.
Okay. Thanks, Sean.